Welcome to Refi TV. I'm Samantha Rowan, and I'm here today with my co-host Billy Procida, as well as Tad Philipp of Moody's Investor Service, and Shlomo Chopp of Case Property Services. Over the past month or so, I've spoken to all of these men about the idea that the CMBS market and the broader commercial real estate market are overheating. So I'd like to welcome everybody here and start off the discussion.
Good morning, Samantha.
Good morning.
Thank you for having me here.
So Billy, you have been very vocal for more than a year about problems in the CMBS market, and Tad, you just published a report saying that the CMBS market is at risk for being the boiled frog. What is everybody seeing in the market that is causing so much concern?
Well, there's a very competitive lending market. There's a lot of new lenders that have entered, and credit quality is beginning to slip. And we think we're somewhere in the late 05, early 06 equivalent. So loan proceeds are a little more full. On the other hand, we still have pretty good debt service coverages, and the property markets are generally recovering. So we're not at the peak, but there's a lot of momentum in that direction, and we're sort of in the late 05, early 06 equivalent.
I concur completely, and I'm not just talking CMBS, I'm talking community banks and even private equity. I mean, look, when everybody, it's like a shark attack, when everybody runs out of the water, there's a complete evaporation, then a couple of people go in the water, and then pretty soon everybody's frolicking in the water again. So what we always have to remember, and we have a responsibility, you know, I think one thing people should realize in our industry is we caused the greatest economic calamity in the last 100 years, our industry. We have a responsibility as professionals and as bankers not to let that happen again. I mean, do you realize that being a banker is now worse than being a lawyer? They did a poll of the top most hated professions. Politicians are still number one. Bankers were number two.
Oh my gosh.
Lawyers were number three. We have now become worse than lawyers. So we've got to get our reputation back. We can't get stuck in the greed. We got to remember that there's a shark out there. There's always a shark out there. It could be Mother Nature, it could be terrorism, but most often than not, it's us and it's greed. And that's what we got to keep in mind.
Listen, you got the B-piece buyers, and they're ready to buy, and everyone's just motivated by got to put deals out there, not motivated by credit.
Other people's money, that's the problem.
Exactly, that's the problem. And whose money are you buying? Someone that doesn't actually know what they invested in, unfortunately, because their mutual fund advising what they're putting their money into.
Well, the B-piece buyers aren't there to protect other investors. They're there to make their own investment.
But where do they get their money from?
Well, they're buying things at a discount. So they're not buying bonds at par expecting to get their principal back. They're almost buying it like it's an interest-only strip. So if they collect their money for 5 or 6 years and then they get the servicing rights, for them that works.
But they are supporting the new issues. They're supporting the feeding frenzy of all the lenders out there. And I don't know, obviously it's highly structured, and depending on which tranche you buy, you have different types of, interest versus principal, and, consider first pay versus last pay. But at the end of the day, you're looking where you have BP's buyers that are there to buy, and you have originators that are just looking to put out money, not motivated by credit, but motivated by the fact that
the origination fee.
Yeah.
And by the way, we're a BP's buyer on single assets. I couldn't imagine having to underwrite 200 loans and know exactly what I'm doing.
They don't.
It's all a matrix. It's all on a computer.
Yeah.
And that also is a really good segue to our next question, because should there be like a standard, like an underwriting standard for the market? That was something, Shlomo, that you had brought up when we were kind of preparing for this roundtable.
Yeah, I think the trouble over here is that the mistake that was made in late stages or 2007, I think has never been cured, it's never been addressed, and continues to be the issue that I think will ultimately either cause the market to halt or cause the market to slowly decline. And that is, first the money was free-flowing. Then there was an issue, so the money stopped. Then it started dripping out slowly. And now it's dripping out more and more. No one knows where we're going, what the line is, so we're all afraid we're going to end up to 2007 again. Who knows? It may stop at 2006. We don't know where we're going. So ultimately, because we're not looking at mortgages as property backed and what the ultimate property is, we're looking at putting out debt on cash flow. There's absolutely no guidance. Everyone's scared as to where things are going to go. And then the originators say, well, hey, this loan's a good loan, and they're right. So it's just a matter of mass hysteria, and no one knows where things are going.
Well, I like Tad's article he wrote about the frog and the boiling, and we were just talking before we started about how the herd moves and everybody thinks they're doing the right thing and being honorable, but at some point the herd's going the wrong way, and that's the equivalent of Tad's boiling frog story.
The CMBS is basically a trade. You turn $100 of loans into $100 of bonds, and the issuer is out. And so for many issuers, a good loan is a loan that doesn't default during the 3 months they're accumulating a portfolio. So that's the nature
I
of the
think
business.
when you talked about standards, I mean, theoretically, everybody that originates a piece of paper in CMBS it's the same piece of paper, because there's only a couple of rating agencies that's got to approve it, and then there's a big herd of buyers. So it's got to look the same. The reality is real estate is not the same. Every piece of real estate has a different attitude, because it's like a kid. I mean, I always say all my real estate's like having children. They don't listen, they're not predictable, they cost a fortune. And the truth of the matter is, depending on the parenting, which is the ownership, is how the asset will behave. And we have to remember one thing. You need a license to build it, you need a license to be the architect, you need a license to be the electrician. The real estate owner and the developer are the only people in America who don't have to be licensed.
I took a look at a bunch of pre-sale, CMBS pre-sale reports, and what I found was actually pretty interesting. You see all these news reports that this lender made a loan at 75% according to their opinion, but then the rating agency came in and said, well, it's 120% or whatever the number they attached to it. So I decided, let me take a look and see what's actually going on. Taking a look at the actual cash flows, the variance between the rating agency and the originator, a couple of percent, 4 or 5% the maximum I've seen. Where the big difference is that these rating agencies had very concrete cap rates for specific properties in specific areas. They valued it based on those cap rates. So for example, they'll value a property at 8 cap. Problem is, the guy bought it, it was in contract at a 6.5 cap, and the originator is using the appraiser's number, which by the way happens to coincide with the amount the guy's in contract for. So it's just, there's something underlying, there's an issue there. I don't know what it is or how to fix it, but...
Well, there's too many people involved. That's the problem. You see, you got to look at who's originating the loan. There is a big difference between the private CMBS guys like Ladder, where management has a heavy amount of skin in the game, and where somebody from Ladder is seeing there's multiple people. I just did a deal with Ladder. They sent out 4 people to see the asset before it closed. I think the rating agencies have a tough job, because personally, I've been doing this 30 years. I still don't know how to value a piece of real estate unless I personally go see it. And in our fund, I personally see every asset. So how does Moody's deal with this gigantic amount of information?
Yeah, let's talk about appraised versus Moody's LTV. So appraised value is an equity concept in my mind. That's what is the building worth today. Moody's LTV is a through the cycle value. Our objective is to see, can you get the loan paid off in 10 years? And will the Treasury still start with 2 10 years from now? I wouldn't want to make a bet on that. So so really we're trying to look at a through the cycle intrinsic value and what is the debt in relation to that. When you look back at the previous crisis, underwritten LTV was 75, 75, 75, 75 leading up to 07. Ours went 90, 100, 110, 120. So you could see that the loans were getting fuller and fuller. Appraisers were using lower and lower cap rates on higher and higher rents. So you're capping 100 a foot at rent at 4, or you're capping 60 a foot at rent at 8.
By the way, your peer group was not as conservative as you were. Am I correct?
Well, we started raising enhancement levels in early 07, and our market share went into a free fall because we basically said this is the risk and the enhancement levels are out of alignment. It's time to make an adjustment. We did, and the market kept going for another 6 months or a year.
And see, that's what happens when you go away from the herd. You're ridiculed. When I wrote The Coming of the Half-Builts in 06, I got hate mail saying, what are you doing? Everything's going great. I said, folks, I ain't a rocket scientist. This just doesn't feel right. I said, my bartender owns 10 houses. I said, there's something wrong here.
Well, a former colleague once said, nobody wants to be the smart unemployed guy. There's a lot of people with big, big groups, and you have capital, you have employees, and so everybody wants to say it's time to get out, but actually getting out very
Never
hard.
good to be too smart too early, but here's the problem. Isn't it the tail wagging the dog? Because at the end of the day, you guys can assign LTV 120% LTV, but someone's buying that tranche all the way down to the bottom level, those tranches all the way down to the bottom level.
When you go back to the RTC and the crash in 88, 89, 90, that was a real estate operator developer crash. It wasn't, the consumers weren't part of the game. This time around, and I don't mean to shift over to Resi, but I believe Resi eventually always affects everything, is the past cycle, they got the consumer involved, which is why it became so cataclysmic. And you know, it's funny because I've been very critical of commercial lenders in general being too aggressive, too fast, but they've pulled in the horns on the Resi side so much that, you know, the pendulum always swings so fast. They've got to unlock some credit to the consumer again, within reason, in order to get the Resi market moving. And we're here in Manhattan, Resi's crazy, but it's all high-end, $2 million and up. I'm talking about out there in America. We need some level of subprime, not this wide, but some give to get a couple of million people back in the game.
Well, there's institutional investors priming the pump with this own-to-rent business. I think I saw in this morning's paper, Las Vegas, of all places, up 24% in the last year. And people are swooping in and buying hundreds or thousands of houses at a time. So the capital markets are beginning to...
well, for the first time I've seen that, because First Key, which is owned by Cerberus, just came out with a loan for own-to-rent.
Right.
And very difficult to underwrite, but they've got the right systems. We've worked with them on their process. I mean, that is a big business. I do think, though, that within 5 years, all of those rental units eventually become for sale units.
Maybe there's two different exits. One is to rent and one is to sell it to a homeowner. But interestingly, we're keeping an eye on the cap rate for houses, because that's how you can tell if there's a bubble. There should be some natural relationship between the price of the house and what it can rent for. And if that becomes too far away, then it's time to raise.
But how do you underwrite repairs and maintenance? One boiler, one tenant, one roof, one tenant.
By the way, it's the most difficult part of that business.
I don't think it's possible.
Maybe we should talk about the elephant that's about to enter the room, which is interest rates.
Yeah, Ted, you were saying earlier that your economist over at Moody's thinks interest rates are going to rise about 2% over the next couple of years?
Yeah, we actually have two different teams of economists. We have Mark Zandi in the Moody's Analytics Group, and we have a capital markets economist. But they both see the 10-year Treasury going back to a normal 4.5 to 5 in a few years. And so basically, I think property prices are probably pumped up by about 20%, because you're borrowing money with a 2-handle Treasury, not a 4-handle Treasury. And you think about you're saving 2 points a year for 10 years. And at some point, when the Treasury rates start to go up, that's a downward pressure that'll offset a lot of the rent improvement we're seeing.
And is that seems like it might hit as well during like the big CMBS maturity bubble that's coming up in 2015, if I remember.
Well, there's a triple whammy, because I think the Treasury rates are going to be higher by 2017. We'll have the refi wave, and we also have risk retention kicking in.
Oh,
well,
so
actually, Shlomo pointed out it might not be a refi wave. What was the term you used?
Try maturity wave.
Maturity wave.
Just a maturity wave. Or
wave.
liquidation wave.
Yeah.
But I mean, you see, I think retail is going to hit tremendously. I mean, think about it. A guy did a Starbucks lease in 2007 at $35 a foot. 2017 rolls around with a 10-year lease. Now he's got a 5-year option. The guy's not exercising his 5-year option. It's way too high for him. He says, you know what, I need a deal. Meanwhile, his lending, he borrowed at a crazy number. At interest only, at a low debt service coverage ratio. Debt service coverage ratios have stayed pretty steady, to give kudos to the lending industry, at the 1.25. It really hasn't gone lower than that yet. And then you got the LTVs, which will naturally decline as a result of the interest rates, and obviously values will decline as a result of interest rates, and also what the debt could be supported. So I think a lot of this retail loans that were made back in the day, or maybe a lot of industrial loans that were made based on LBOs.
They're not going to underwrite anymore.
They're not. I mean,
they're not going to underwrite.
Starbucks might be the only tenant that doesn't have to worry about the internet.
Yeah, well.
but so many others do, and a lot of tenants, they're either closing stores, shrinking stores. And in office buildings, people are squeezing more people into the same amount of square feet. So it's a dynamic.
It's getting to the point. Would you agree? Where we really don't need any more office buildings or any more retail.
With some market-specific variations, but generally...
I think quantity. I mean, there's a lot of buildings that should be demolished.
We have a lot of self-inflicted wounds. In the 1980s, people built too much. I think there was a theory that real estate was the perfect inflation hedge, but unfortunately, the rules of supply and demand were not repealed. So you build too many buildings, rents go down. Even if the cost of copper and glass go up, empty space, rents go down. And then this last crisis wasn't about too much building, it was about loaning too much money on the same buildings.
Multiple times, as Moody's saw as, the big trophy assets.
And sometimes things outside the U.S. can be the catalyst. So we set it's a cyclical business, and we set ourselves up towards the peak, and then the question is what pushes it over the edge, and sometimes it's domestic or international.
And that's actually a really good segue to my next point, which is just about the apartment sector. As you know, there's a ton of money coming into the apartment sector from international and U.S. investors. Values are up, leverage is way up as well. What's next for that sector, especially in light of the GSE reform that's coming?
Yeah, Fannie and Freddie have been shrinking their balance sheets, and CMBS, the share has grown from 10% multifamily to 20. So CMBS has stepped in, banks and life companies have stepped in as well. And the Johnson-Crapo bill is a constructive start towards liquidating the GSEs. But ultimately it needs to be handled very carefully because they account for about half of multifamily debt financing. And from a credit perspective, we're always worried about the availability of debt and the price of debt. But it seems like a good constructive start.
I guess from my perspective, the government maybe is removing itself from funding, but the government's still involving itself in every other part of funding except putting out the money, from where I sit.
Well, they're the buyer.
No, but even the rules, the Dodd-Frank rules, the risk retention rules, all these various meddling into things that, quite frankly, when you go to school for political science, you're probably not the best guy to be dealing with financing. So all this meddling, I think, is going to do more harm than good. But I do agree, it's the hottest sector in commercial real estate.
Whatever's hot eventually cools off.
Yeah, but why is the government helping out the hottest sector?
Makes no sense.
Third-tier malls, I get it. Okay.
Well, it's a source of capital no other sector has. Everybody has banks, CMBS, and life companies, and apartments have Fannie and Freddie also. So there's and in fact, their property prices didn't dip as much in multifamily as they did for the others because the GSEs kept capital coming through the crisis. And CMBS pretty much shut down. It went from $200 billion to zero, and now it's working its way back up to 50 or 60.
Insurance companies are still there. Insurance companies
they modulate.
I mean, even the community bankers are starting to say it's overheated.
Yeah, that's the only section of multifamily, is the only one where construction's in full swing. I mean, we're seeing it in more and more markets. Only in one or two, like Austin and Raleigh, has it gotten overheated, but rents have basically risen to the point where construction makes sense. It's still years away in office and retail for construction making sense. Or like you were saying, maybe there's, retail's under demolished. So
that was Dan Horowitz from DDR. It was not my line.
Well, when CMBS figures out small balance, that's when I think CMBS will really turn on.
Well, that's where our biggest mess was from the last cycle. People were just starting to do small balance loans right at the peak, and they were shoveling them out the door with a lot of quality controls.
That was compromised underwriting. It wasn't that it was a bad market segment.
All underwriting was bad. Small balance was worse. It was one of the worst things that came out of the end of the last cycle. There's no reason it shouldn't be done well, but it wasn't.
It's the same argument that single-family residences. Your income stream is way too small for the risk you're taking.
And so we're very close to the end of our panel, so I just wanted to put forth one final question to everybody. Is the CMBS market really like a frog about to get boiled, or will it be able to jump out of the pot?
Well, the water is warm and it's getting hotter, and a lot of people think they can jump out at the last minute, but history shows that people get a little bit complacent and the unfortunate result happens.
Well, I could tell you this. I didn't know what a frog getting boiled is, so I went to YouTube. And there was a video of a frog getting boiled. And I looked at him, and he looked like a few bankers I know. They knew nothing. Yes, in their own world, it made sense what they were doing. And as I said before, the loans being made are good loans. But it's been loosening. It's been loosening more. It's been loosening more. At what point does it just slip? And I don't know the answer to that, and that's why I think it's a great analogy.
Well, I don't think it's limited to CMBS. I think it's the herd. And whoever's at the front of that herd has got to be very careful because they have thousands and thousands of other people following them. So if the leaders of the pack who took us over the hump and over the cliff last time let that happen, we will go over because our industry just does not know how not to follow the herd. And we have to remember that we caused the biggest economic boom, we caused the biggest economic bust. We have a responsibility to our fellow Americans, and I don't mean to be overly patriotic, but listen, It's the truth. We can never let this happen again.
Cool. So thank you everybody very much for being here, and I'm Samantha Rowan.
Billy Procida?
Thanks, Sam. Ted Philipp.
Thank you for having me, Sam.
And this is Refi TV.